Hello, and thank you for joining us on the Optimal Wealth Podcast, where we discuss creating passive income through real estate. Our mission is to help educate investors on how to grow wealth and invest passively. My name is Jarod Alexander, and I am a passive investor, currently in 6 syndications as a limited partner. I am also the founder of Optimal Equity Group, which is a real estate investment firm that was created primarily to help educate the passive investor. We do that in a couple of different ways. One is we provide education to help give you the confidence to get into the passive investing space. And two, each episode we will interview amazing guests that explore the strategies, insights, and secrets used by successful investors. Whether you're a seasoned investor or just starting out on your real estate journey, this podcast is designed to help give you the confidence and knowledge you need to make informed and profitable decisions. Welcome to another episode of the Optimal Wealth Podcast. My name is Jarod Alexander, and I am your host. And today I'm super excited for our guest here, Ruben Greth. Ruben, welcome to the show.
Jarod, it's an honor to be here, dude. I'm stoked. Thank you.
Well, we're happy to have you, man. I'm excited to dive into a little bit of your background and how you ended up to where you're at today.
Okay.
But before we get started here, let me give a little background on Ruben. So he has been scaling and heavy lift apartments and value-add multifamily syndications since 2019, where he started as an apprentice with a Phoenix-based operator, found his niche working with and developing co-GP partnerships. So as he forges into multifamily, he simultaneously launched the Capital Raiser Show podcast, which is where I met Ruben, and interview-based thought leadership, and creates content designed to help scaling syndicators, raising capital compliantly with best-in-class strategies, technology, marketing, psychology. You know, a couple highlights here. You know, he's been a joint venture in 22 residential multifamily units in Phoenix, a co-GP on a 90 unit in Tucson, Arizona. Been scaling and development and management of private equity company called Legacy Acquisitions as a former partner, and has been heavily involved in the build to rent space, which we'll definitely get into a little later on in the episode. So with that, Ruben, let's, if you could tell the audience, you know, where you were and how you got to where you're at today.
I appreciate it, man. I'll try and keep it brief. I got my original start just by launching a little meetup here in town called the Phoenix Real Estate Investors back in the day, and would just invite guests. And one dude showed up and he was buying a fourplex every other week. This is back in 2009. And I asked him, I'm like, hey, I don't understand how you're taking all these things down. Do you have a bunch of money? He's like, no, I raised the capital. I'm like, really? Let me cruise around and follow you to your projects and then put it on social media and see if I can help you raise some capital for this. And he's like, okay, like I suck at marketing. And sure enough, like I followed him to his projects and then posted a bunch of videos. And over like 9 to 12 months, I raised $625,000 just from social media. And that became my first introduction into raising capital. I'm not sure if it was totally compliant, but we didn't do anything wrong. There was some advertising, I suppose. We never asked people for money, but we did say something like this. Hey, this is what we're doing. If you're interested in partnering with us, you know, come join us. We made a bunch of people JV partners of ours, and that's how we did it originally. I ended up breaking up with that guy and left real estate altogether for like 5-6 years. And when I came back, all I knew was fourplexes. Like you mentioned in the intro, I did like 22 units. I think it was a 4, a 3, another 4, and then a 12. And then I left real estate. And so I wanted to do a bunch of fourplexes, and somebody's like, how many of these do you want to do? And I'm like, I think if I bought 32 fourplexes over the next decade, that would set me for life. And they're like, that's about 120 units, 128 units. Why don't you just take them all down right now? And I was like, what? Like, I don't know how to do that. And so they introduced me to this thing called syndication. And then I got really interested and was like, I got to figure out how to do this, man. So I joined a local operator, told them I had raised money for small fourplexes. They're like, really? We need somebody to raise capital. So I came on board with them, and they're like, okay, we brought you to raise money. Like, where's the money? Where's the money? And I was just like, dude, like, I'm just barely getting back in the game. I don't know how you guys raised it for this. So, but they needed money for like a 90 unit and some other projects. And so I had built some relationships from my previous meetup. And I asked a few people, I'm like, hey, are you guys interested in partnering with us on this? And sure enough, I got a few co-GPs. We gave them an equity position in our company and they brought like about $1 million. So most of the money that I've raised, like about $3.5 million, has all been co-GP capital or joint venture capital and very little from limited partners. I know this show is for and designed for the limited partner. So I'm happy to talk about that and the exciting and sexy things about passive investing as a limited partner. But, as far as my story goes, that kind of led me and introduced me into the syndication capital raising space, left that company and joined forces with the build to rent operator, helped him raise about $1.5 million, possibly more. I just had a conversation with him today. And that space is very interesting, very different and more dynamic and higher risk, higher return kind of profile versus a typical multifamily value add syndication, but very sexy asset class, particularly right now. So maybe we can dive into build to rent a little bit later down the road. But yeah, so now we're building about 100 units. That one's almost on autopilot. And then we got 2 other pieces of land that we're attempting to build like another 250 units on, maybe a little bit more than that, like 275 units on right now. And that's where I find myself today. I helped grow this company, Legacy Acquisitions, from about 3 or 4 people to about 11 people. And then the direction that they started going in was different than what I wanted. And I started losing my voice a little bit. I wanted to do build to rent here in Phoenix. Those guys wanted to do stuff that was different than what my investment thesis became. So we are still in those deals together, but I am no longer managing partner of Legacy Acquisition. So now I'm solo. I want to launch a fund a little bit later on this year, probably focused on Phoenix real estate, Phoenix Airbnb, BTR, possibly some distressed multifamily, and definitely some debt. I really love fix and flip debt, particularly in Phoenix, Arizona, or Arizona in general. So that's where I find myself today, still running the show, having a lot of fun networking with people like yourself at different events around town and around the country. And it's been a wild, fun journey, man.
Yeah, no, that's awesome, Ruben. And yeah, lots to unpack there in that little 3 to 4 minutes. And, I want to start out first. So when you got into real estate, you started right into that fourplex raising money. There was,
Yeah.
wow, yeah, which is pretty unique. You don't typically hear that. Usually it's the single family route and, kind of starting in that and then going transitioning to multifamily.
So when I started, this was back during the real estate crash of 08, 09. And Phoenix was having a fire sale because there was a law that passed that made it challenging for Hispanic and immigrant citizens or immigrants to keep their jobs here because the Social Security laws became a little bit the proof became a little bit more difficult for them. And then so we had this mass exodus of a lot of Hispanic people, and a lot of them lived in fourplexes. So there we had essentially a cherry sale where you could go and buy a house with a threeplex in the backs for like $72,000, or like a threeplex for like 56 grand. Or I even bought a threeplex for 40 grand back in those days. So everything was super, super, super cheap.
Yeah.
And like, and we would take down these things like 100% cash.
Yeah.
No
Well,
financing whatsoever.
it's crazy because I remember just probably 2 or 3 years ago that we were looking at a fourplex here, and we're both here in Phoenix, Arizona, and this was, kind of in the middle of Phoenix, the heart of Phoenix, and it was about almost $700,000,
That's
right?
crazy. Crazy to think of how
So
much. I
yeah,
should have kept all of those fourplexes, dude.
no, you'd be sitting pretty nice right now. Hindsight's always 2020, isn't it? No,
Mm.
yeah. Well, so you go through, okay, so you start raising money, right? You raise $600,000, which is pretty impressive in itself, right? Just starting out. And then you JV. And for those that don't know what JV, Ruben, through some JV, co-GP, JV is a joint venture, right? So you
Yeah.
typically have 3 to 4 people or anywhere from 2 to 4 people come into a deal, pull their money together, and they go out and buy an asset.
The main thing here that people need to realize is that these partners, they cannot be passive or else it becomes a syndication. So like in terms of legalities around capital raising and staying out of jail and out of trouble, like those guys have to have ongoing duties, whether that's like, hey, I get to choose who the broker dealer is, or who I should say the broker who sells the real estate is, or I get to choose the paint color and what appliances go in and what's the process for putting the tenants in. They have to have some duties besides just like, hey, here's the money, go do it, and then pay me when you're done.
Yeah, yeah. Thanks for noting that. Yeah, definitely had to be active in the deal. And then for co-GP, kind of similar in a way. You definitely have to be active in the deal, but this is more on a syndication, right? So it's called a co-general partnership with an
Yes.
operator, right? And so you're helping, and you could help bring capital to the deal, but you have to be still part of the asset management or be involved in the operations at some level. So
Yeah, this is actually a great place to pause because, if I'm looking at projects from a passive investor, a limited partner perspective, I want to know what the operators are thinking, how they structure their business, and whether or not they have a bunch of co-GPs on their team, or if it's just like one sole major partner that runs the whole thing. Because a lot of voices in the kitchen can kind of cloud things and make it murky and more challenging on a number of levels. So, I mean, if I was a passive investor, and eventually I want to be 100% passive and completely hands off, like the listeners of this show are, I would want to select somebody who's got a track record of doing and being able to do deals on their own, most likely, unless they're very special operators that have an incredible track record and a very amazing investment thesis. And I know some people like that too, that I would probably invest with passively, even though they have a bunch of fund managers helping them raise capital for their deals.
that is a good point, Ruben, and thanks for making that, because a lot of people that are listening to this show are just getting started out in the space, so they don't know what to look for, what questions to ask a sponsor. So that's definitely something to watch out for. Is how many co-GPs are in the deal, because they have an active role in that deal, and like Ruben said, it can get mercury, right? It can really mercury the waters there. And so, Ruben, on that note, so like if somebody is getting into their first passive investment, and just a reminder about Ruben, he has a lot of experience on the operator side, especially in the build to rent. And we talked about, he had a 90 unit, his co-GP on a 90 unit in Tucson. So what should a passive investor be looking for? Obviously, we talked about co-GPs, track record. What are some other things they can ask the sponsor or do their due diligence on?
Yeah, I think I have some good advice for you guys. However, I want to spin this a little bit and make it a mindset thing so you guys can see how my journey has affected the way that I raise capital and how people judge me as a capital raiser sponsor, right? So like when people ask me to raise capital for them, I now say no. And like as a limited partner, it should be more than just like, hey, I know this dude who's doing this thing called syndication and they're making a bunch of money for people. That's not enough information, no matter how much you love the person that introduced you to this game. So let me tell you about what happened when I started hanging out with these ultra wealthy people that are referred to as family offices. I go to the family office club with my subdivision that we've, completely raised capital for. But at the time I was trying to raise capital for it. And they were looking at me and they're just like, so tell us about your deal. I'm like, oh, we're building 100 units out in Louisiana. It's lucrative because of this. We feel like we can do and accomplish this thesis, and our builders are amazing. And like every single reason why build to rent is incredible. And they just kind of like, they're like, you realize that the dude right next to you has 17,000 units and you're working on your first deal and you haven't gone full cycle and you have no gray hair and you've been in this business for how long? And, like I had no defense, right? I was new. I had not gone full cycle. It was my first development. And I have been around for some other previous market cycles, like the crash of '09. But these guys are talking about like previous crashes from the 70s, 80s, and 90s, and I don't know anything about those. So they kind of laughed me out the building. And I was just like, how are we going to raise capital for our deals here? And what I started to realize is I listened to these family offices speak from on stage is what they wanted, which is executive level reporting, a lot of gray hair, a lot of track record, a lot of full market cycles and economic cycles experience. So I thought to myself, well, how can I can't do that myself. Let me go find a sponsor that meets all of these criteria. And it upped my challenge, right? Like now I have to go find somebody that's absolutely incredible that meets the standards that these ultra wealthy family offices have. Well, my advice to the limited partner that's listening is have some super high standards, right? Because there's tons and tons of people that I'm coming across. Like we were just at Raise Fest, I think maybe a few weeks ago or whenever this is released, you guys go back and think about when Raise Fest was. And I was running across a bunch of passive investors that became capital raiser fund manager type people. And they're like, yeah, capital calls. We lost money on this deal. Everything was so sexy in 2018 and 2019. And I thought that I could not lose. And here I am, all of my money's down the drain. I'm still in the deal, but they're going to liquidate it. And none of the investors are going to get their capital back. So you got to really start thinking about, and I think this is why a lot of people have pulled back from the limited partner pool. And if you want to get in the game, getting into real estate is very intelligent, but be super, super selective. Go to somebody who's done it like 10 times, 15 times, and see who they're investing with and how they are looking at it, because, you can talk to somebody who's a pro or who's been around, like Jarod or myself. But if you want somebody that you trust, like from your circle of influence, try and find somebody in that circle of influence that has been around the block a few times versus somebody that's just like in their first limited partner deal. It's really, really important and imperative that you don't make a mistake, especially when a portion of your nest egg is on the line, right?
Yeah. Great point, Ruben, because it's so easy to talk about the returns you can get, the sexy returns. You double your money in 3 to 5 years. And going back to 2019 through 2021, some of these deals were turning in 14 to 18, 24 months, right? Which, you could just hand your money to someone and double it in, no time. But now we've seen these deals as as we all need to understand getting into them, there are risks involved, right? And it depends on where the market is. Nobody saw the interest rates increasing the way they did in that short amount of time. And it left a lot of people, like Ruben had mentioned, capital calls is where, for those that don't know, is where an operator has to go back and ask the investors for more money and hopefully to save the deal. And hopefully they do save the deal. Some of them still foreclose, right? And so these are the risks, that, it's my job or Ruben's job or whoever you're looking at partnering with needs to be educating you about, like, for one, you don't need to be investing money that you need for daily expenses or mortgage or rent. Like this is an illiquid investment, right? Typically 3 to 5 years, your money is going to be tied up. But you need, worst case scenario, you could lose all your money, right? Now, the chances of that are happening, as long as you invest with a good operator, we definitely minimize that as much as possible, but that could happen. And so, when you are looking at an operator like Ruben had mentioned, is do your due diligence, look at the track record. And something that, like what I do, and I know Ruben does this, is I partner with operators that have a track record. I get people that reach out to me daily or weekly. Hey, Jarod, can you come and raise on this deal? And I'll have a conversation with them, but I say, hey, you know what? Throw me on your list. I want to see what you're doing. I want to sit on the sidelines. And then whenever I feel comfortable after my due diligence period, then I'll start taking a look at, possibly partnership in the near future. But again, Ruben, thanks for that clarification, because it's something that we can definitely glide over. But this is our hard-earned money that we work for. I'm invested. I'm a limited partner in now 6 deals, and I definitely look at this stuff before I'm handing my money over to someone that I want them to be a good steward of my money, right? And I want to grow. I don't want to lose all my retirement. God forbid if I did, I'm at an age where I can definitely recoup that, but my goal is to minimize that as much as possible. Right. So understanding, educating myself, networking, going to these meetups like Ruben and I go to and things like that. That's what we're doing here. All right. Well, so let's talk about asset classes, right?
Okay.
So I've had some guests on here. We've talked about the multifamily value add, which is where I'm heavily niched down in. I had someone on the other week for self storage. We've talked about retail, but let's dive into the build to rent a little bit. If you could educate for the listeners that don't even know what BTR means, right? Like, what is that? How does it
Yeah.
work? What's that look like?
Yeah. So build to rent and construction of housing has a lot of misconceptions. And what happens in Portland is very different than what happens in Arizona versus what happens in Florida versus what happens in New Jersey. So I'll start there. But essentially, the process of build to rent is you're looking at building a subdivision of homes, like let's say anywhere from, a small infill project on 1 acre where you squeeze in 40, units, like 10 fourplexes or something like that with units, 4 stories high or something. Or, you can build a group of townhomes, or in our case, we're building 100 cottages, A-class cottages in Louisiana. And the exit strategy at the end is kind of an important part here, because a lot of builders and a lot of people that are looking at development, they think that they all kind of get paid the same way and they all have some of the same exit strategies, which is completely inaccurate. What we're trying to do is build out this entire subdivision of homes 10 at a time and then get them rented and then sell the entire subdivision as one commercial real estate asset to a single institution or syndicator or purchaser that wants to have. A lot of people want to have single family homes, but they don't want scattered site property management. They want all of their homes in one place with one property manager, with one leasing agent, and the subdivision meets that criteria. So what's fascinating about this, and I'll run down some benefits, right? Because we feel that it's very similar to multifamily in the way that we operate this particular thing, but development is slightly more complicated and higher risk than a typical multifamily value add. But what we like about build to rent is that the residents, they tend to stay for 40 months instead of the average for apartments, which is 18 months. These particular renters or residents, as we call them, they pay the most and default the least of any segment. And the rents are rising fast because people don't want to live. A lot of people don't want to live with somebody above them, below them, to the left of them, to the right of them, and then have this little tiny patio. It's kind of hard, as Neil Bawa says, to fit 2 parents, 2 adults, and 2 dogs and squeeze them all into an apartment. So people are really, if they can't afford a place to live because rates are insane or nobody wants to sell their home because they're locked into a great rate, and that's causing this lockdown and not a lot of value, and you kind of want to wait to see if the rates go down, what are you going to do in the meantime? If you want to live in a home, build to rent is incredible. So investor sentiment nationwide believes build to rent is going to outperform many other commercial real estate asset classes. I'm of that mindset. There's massive demand from institutional buyers who want these entire subdivisions with all their homes in one place. There's low maintenance because they're brand new. They typically have no maintenance for 10 years. It's very lucrative for the GP, the LP, the co-GP, the general contractor. Everybody's making a bunch of money. They're like detached horizontal multifamily. Like we said, everybody's in one place. And the residents, they get a backyard, doggy door, driveway, amenities like dog park, walking trails, etc. From my perspective, I like it because we don't have to compete with a bunch of other syndicators that are bidding for the same property. So there's not a lack of deal flow, but you have to be able to you have to be very good at executing your business plan. And it's easy to follow other developers into their markets and mimic exactly what they've done and copy them almost exactly, maybe do a little bit better quality. The governments where we like to invest are pro-growth, so they want to provide housing, and the cities help us through entitlement zoning changes because they're trying to get affordable housing or good housing for the people in their city. Is a lot of these cities, they want to grow. So it attracts higher income tenants, has on-site property management, amenities, great rents. However, and then I want you guys, the limited partner, put on your capital raiser general partner hat on and pay attention to this, because this is what makes this particular asset class very challenging for operators. When you guys are analyzing deals, you a lot of times want to pick something that's easily understandable in a market that is close to you somewhat relatively. Like if you're in Arizona, you probably don't want to invest in Florida and vice versa. But when you talk about multifamily, I think the limited partner understands that business model. It's not complicated. You buy an apartment complex, you take care of the residents, you make their property a little bit nicer, you lower expenses, you increase efficiency, you improve the property, improve the rents, it's worth more, you sell it. That's it. It's very uncomplicated. But as soon as you start telling people, hey, we're in Louisiana and we're dealing with the city and we found a bone in our core sample of the dirt, now we have to do an archaeological study, and that's going to delay some things. Oh, and by the way, that the cost of cement has gone up and the cost of lumber has gone down, and the banks want more reserves, so we need a little bit more money to get across the finish line in phase one, which is just the entitlements. And then, like it's a different risk profile versus the second phase, which is going to be the infrastructure where we put in utilities and sewer and electric. And oh, and by the way, we're not connected to the city, so we have to create our own sewage plant on site. And they're just like, dude, what? That's crazy. Like that's so many moving parts where things can go wrong. The developer is thinking to themselves, hey, we got this. We've done this before. It's, we expect problems. But the limited partners going like, dude, this is a lot of moving parts. I don't know if I can handle this, right? So unless you're a sophisticated limited partner and you don't like the greater return, greater risk of a development, a lot of times it's harder to raise capital from people who are analyzing, even though we could offer you a lot more money than a multifamily. But it's a great, amazing asset class. I ran down a ton of benefits, including the fact that there's no housing. There's a massive shortage of housing. So we like build to rent, but now I'm starting to look at instead of doing this shiny object way over in Louisiana, how can I bring my expertise and my partnership and my raising capital abilities to a market that's a little bit more familiar to people? So I want to start doing it here in Phoenix with some people that I know.
So, a couple questions that come up for me. So, when you talk about the exit plan, because that's very important to me when I'm looking at deals, what's the exit strategy, right? And from the little I know about build to rent is, one thing that I heard, that is attractive is you could, depending on how you zone these, right, when you're building them, but you can sell the houses out individually.
You could.
Right? Is that and I to me I like that strategy because I'm like, because if somebody's not willing to buy the whole portfolio, you're stuck with 100+ homes or whatever that is, right?
That's part of the sell, right? So when we tell people that there's multiple exit strategies that we can sell at any stage along the way to somebody that makes us an offer, or go and seek somebody, whether it's at the land, after infrastructure's done, in the middle of building the houses, or after it's completed, before it's rented, or after it's stabilized. And you have different ways that you can sell it. You can sell it off as individual houses. You can bulk them in groups of 10, or you can sell the entire subdivision off, or you can keep it for 2 years and then sell it to avoid certain tax consequences. There's all kinds of things that are very sexy about build to rent development, including how much forced depreciation you have control over along the entire development project, from dirt to residents inside homes. But for me personally, especially if I'm building 250 unit subdivision, 250 houses, like I think 250 individual escrows dealing with a real estate agent and buyers, I think is brain damage waiting to happen. I don't want to go through that. So I'd rather probably make a little bit less, but possibly not. Here's an interesting thing that I found out about build to rent that I did not know. If you have about 500 units, maybe like 3 subdivisions, 100 unit, 150, and a 250, an institution will actually pay a premium if they can buy all 500 units, way above and beyond what a single family retail purchaser would pay. Why would they do that? You would think if they're buying bulk, you would give them a discount, right? Well, the reason is because they have so much money that they want to deploy these, these institutions and family offices. They want to like take down stuff 20 million bucks at a time. And when they're doing deals, they have crazy levels of due diligence. So they want to look at your subdivision on the left side of town, in the middle of town, and on the right side of town simultaneously and do due diligence on the entire thing. It's cost effective for them. And they don't want to do this, let me cherry pick this deal and not this deal. Like they want the whole thing performing, cash flowing, and they want to take it all down. And so much so that they'll actually pay more than an individual retail buyer. And that's why you hear all of this complaining going on in the media about like, all these institutions are taking our homes from us, screw them, and they're flipping them off. Well, the reality is that when you can take down a portfolio of 1,000 homes or 500 homes, you're going to outbid the single family, and that's not helping home ownership. So that's something that probably needs to be addressed, but we can do what we can do. And like if we can't solve the affordable housing crisis for people that want to be homeowners, at very minimum we can prevent them from living in an apartment. If they want a backyard and a dog, and to have multiple amenities and things that they can't have in a home, then at least we can solve them that for now until they can qualify for loan. And hopefully, we have a presidential candidate that comes in and then helps the economy to some extent, whatever that may look like. Because right now it's not looking favorable for the person that wants to become a homeowner in the near future.
Right. Well, and just to clarify, so going back to the due diligence, when you're looking at an operator, whatever asset class it is, but specifically build to rent right now, is pay attention to the zoning, right? And help me clarify this, Ruben, make sure I'm on the right path here. But from you want, I like the different exit strategies, right? So just being able to sell them off and, bulk of 10, 20, whatever that is. Some of these are zoned where you can only sell them as one.
If they're not properly subdivided, that could be the case.
Yeah.
Right.
Yeah.
So part of the developer's job in the beginning is to determine whether or not they can apply city delineations and adjust. Sometimes it's challenging in historic districts or certain areas of the city, or the suburbs of the city. But so what a lot of people do to mitigate that risk of, I don't know if I'm going to be able to change the zoning, is they'll put an offer with an option to purchase on a piece of land, and they don't execute the completion of that purchase until they've changed the zoning already. Right. So here's $25,000. I promise to purchase this if I can get the zoning changed. And if they don't approve the changes, you keep my 25 grand. And they're like, okay, I'll take your 25 grand and good luck with the city. And then if you're smart enough to know what you can do within the city, like hopefully you have some kind of architect, some landscape architect, or somebody that's really good at acquisitions, then, you change the zoning and then you complete the purchase and you already know what you can do. For some people, it is very important to have a property that you can subdivide into multiple lots. You want to find that out in the beginning if possible. And some people will go ahead and execute the plan anyways, even if they can't subdivide it. In fact, we were looking at a piece of property where we were just going to build the whole thing and sell it as one single parcel, but, and try and change it along the way. And if we can, great. And if not, either way, we're still selling the whole thing off. But I think at the end of the day, it becomes a little bit more valuable if you can force that little piece of appreciation by having an entire subdivision that's already individually plotted or subdivided into individual plots.
Right.
So yeah, the zoning is important. The entry plan, the exit plan, the plan in between, they're all incredibly important. They're moving pieces. That's why it's so important, I think, in development for you to find somebody that's done it a few times or that has some level of experience and ability to execute.
Yeah, that makes sense. And real quick, because I want to jump into our next segment here, but if you could just highlight the returns real quick, like what is now again, these are just projections. based on
Well, I can talk about them because everything that I do, because I have a podcast called the Capital Raiser Show, I only do 506c. So I'm allowed to talk about stuff.
Gotcha.
But essentially, I'll tell you, without going into details about any specific deal, I'll tell you what we're trying to accomplish. We want to double people's money in 3 to 5 years. The way that we're underwriting it is we're telling people, hey, we can basically double your money in 5 years. But internally, we believe that we can, from the moment that we accept the capital until the moment that the houses are done and rented, we believe that we can do that in 3 years. Now, here's the caveat, because we're not accepting investor capital in the land phase from the same people that we're accepting capital from during the syndication phase, which is like the construction of the actual homes. Right. So what we do is we take down the land with our own money, and then we raise some money, which is a little bit higher risk, higher return kind of money for phase 2. We complete the horizontal infrastructure, which is sewer, streets, electric, plumbing, sewage plants, whatever, like get it house ready. Yeah. All of the pads have been put in, and now it's just ready for the houses to go up and go vertical. So we raise money, we either return the capital at that point, or we keep the investors in, and then we launch a syndication. So the thing with syndications is a lot of limited partners want their money back as fast as possible and with least risk as possible. And when you get all the way to the end of stage 2, where everything is ready for vertical construction, that's the least risky phase. So even at that stage, we're still doubling people's money in about 3 years and underwriting it with some conservative underwriting for a 5-year period. But we believe that we can do it a lot faster. And all of this stuff is in the legacy acquisitions deal folders that you can find at their website.
Nice.
So that's kind of what we do. The business model is going to be slightly different here in Arizona. Land is a little bit more expensive. I would probably change from doing suburban subdivision development to infill, because I can't compete with the guys that are in Buckeye that have like $1 bazillion and can wait to go through zoning and don't care. They build at such high velocity and quantity that I can't do that stuff. But I can do like a 72 unit in the middle of, South Central Phoenix, or somewhere close to South Mountain, or maybe in some of the other parts of the city that have, 1 acre, 2 acre, 3 acre, 4 acre lots. So I think it would be fantastic to get into that business here in town, and look for me to partner up with some guys here in the next year or two on that space.
Awesome. Yeah. No, thanks for clarifying. And just another clarification there on returns is, this is new development. So if you're looking at cash flow, that this might not be the opportunity for you.
No, it's cash. So that's a great point. It's a different risk profile, and dirt does not cash flow.
Yeah.
Right. So that's you get a bigger back end equity spread and participate in parts of ownership at a much higher and get to receive the benefits of forced appreciation at a higher level than you can in a lot of other commercial real estate. But you don't cash flow. So here's another thing that's kind of interesting is when we take money in phase 2, some people can double their money in 6 to 12 months. Right. But what happens if you're, you end up with a bad operator, or something happens and there's a miscalculation and you can't proceed with zoning, or, like what's been happening recently, like the insurance rates have skyrocketed, and what used to be a good business plan no longer makes sense because insurance rates went from like $200 per unit to like $1,200 per unit. Stuff like that can happen. And now you're just like, oh, we got this piece of land that we can't do anything with. So it's a little bit riskier. Yeah. But hey, how does doubling your money in 6 to 12 months sound? Right. So yeah, it's a different risk profile. However, that's the name of the game with development. It's not quite as clean or clear cut as regular value add multifamily syndication, but that's why you get a greater return.
Yeah. Bigger the risk, the better the return, right? All right. Well, Ruben, let's go ahead and transition into what I call the fire round.
Let's do it.
All right. So I'm gonna ask you 4 questions. And the first one being, if you could recommend a book on investors just getting started out, focusing on real estate, and then another book on cultivating a positive mindset, so more mindset based.
Okay. So when you said real estate book originally, I was thinking the highest and best use book by Mike Watson that was written in 2008. It actually kind of goes into the same philosophies as build to rent developments. It's like, hey, you can force appreciation, you can capital raise through something called seller finance. It's really a good book. I don't know if it's designed for passive investors, but it's excellent for active investors. On the passive investor side, probably like I would want to say Brian Burke's book, which is called The Hands Off Investor. So I would check that out if you're interested in learning about the passive. I believe Dan Hanford just came out with a book too, so look him up.
Yeah. And then what about a mindset book?
Mindset book, the one that has most recently impacted me. A lot of people have heard of Napoleon Hill, but they don't know that he's written like 30 books. And I'm not talking about Think and Grow Rich. I'm talking about one that was recommended to me by an individual named Zach Kaptenstall called How to Own Your Own Mind. And it really shifted my paradigm in a lot of ways about, people talk about the who, not how.
Mm-hmm.
And this book is like, you need the who, not how, but you also need to work your butt off. It's not like, this is a kind of a side gig and I'll just hire other people to do it for me. It's like you have to work if you want to be like in the $1 million category or own millions and millions of dollars of real estate and be an operator. Like you got to hustle your brains out and work smart, not just work hard and not just work smart, but do both. And this book by Napoleon Hill, that's actually an interview of Dale Carnegie, phenomenal for that. So highly recommend it for mindset shift.
Yeah, just real quick, thanks for touching on that. I was actually on an early morning mastermind I get on Friday mornings, and we were talking about the who not how method, right? And I kind of had it I brought it up in my business where I'm looking at outsourcing something, but I'll be honest, I don't necessarily want to spend the money to do this, and then I'm having to analyze, okay, yeah, if I spend the money, because it goes into that limited mindset, right?
Mm-hmm.
Or is this something I can work my butt off and do, right? And learn along the way, because I think there's a huge value in doing it yourself where you are learning, right? And then you get to a position where you could outsource stuff more. Or do I just outsource it, right? But the who not how book can definitely have that, give off that, or where you just hire people and just stick to what you're good at, right? And there's a
I get it, man. I struggle with it too.
yeah.
Right? Like I don't want to outsource my podcast video editing because there's nobody on the planet that could do it with the same level of intensity or OCD that I have. But if I don't automate, eliminate, and delegate things that impede my progress to becoming a better syndicator and better capital raiser, then I'm failing at the game. So like I get it. Like it's hard to let go of things. It's hard to pay that money. But man, that's a decision that I think a lot of entrepreneurs have to grapple with. And at the end of the day, man, if it's impeding your ability to progress, you got to get it off your plate.
Yeah. Yeah. No, I agree. Well, let's go into our next question here. So, can you share a specific goal or dream that holds a special significance to you? So, what's a goal or dream you're working towards in another way?
So I got goals in all areas of my life, physical, mental, spiritual, and emotional. Right now, I think one of the biggest goal for me is I want to be a dad. So there's some things that are preventing that we require probably some health insurance for. So I'm very positive that it'll happen on God's time. But I'm like 50 years old, dude. So you're very close to it. So I don't know that I want to be running around with like 20-year-olds when I'm 75, but that's what it's essentially kind of looking like.
Yeah.
So we'll see. But that's a big one for me, man. On the income side, right? I'd love to own 1,000 BTR units or essentially make $25,000 a month passive income, which is essentially 25. What is that? $2.5 million per year or $2 million per year. Divide that up and you should be somewhere in that 25,000 a month range.
Yeah. Yeah, my goal, yeah, is very similar there. $20,000 monthly in passive income, and that way, I could just live the life I want, and yeah, don't have to worry about, have that option to be work optional. Right? But I'll be keeping you in mind too with the kid, man, and keeping you in my prayers there. I got two of them, and
Thanks.
it's yeah, it's definitely added to my why and why I'm doing this right now, and on this journey. All right, well let's go to the next question. And now I just revised these, Ruben. So you're the
Yeah,
first.
I noticed. No, it's all good.
Throwing some curveballs at you here.
That's cool. I like her balls.
So so tell us about an experience that didn't go as planned. And now this could be in the real estate world, or this could be in the uh, your personal side.
Yeah, I think this particular situation will help passive investors too. Is like I mentioned that I got involved with a company that I did a 90 unit for here in Arizona. And, like when I was getting into the game of syndication, like I just wanted to be in the game. I wanted to have some kind of partnership duties, and like I wanted my investor card and like the ability to raise capital. Like I think I ended up picking somebody who had a good track record of acquisitions, and they seemed to love the residents and take care of them, and they went to church and they seemed very spiritual. And then when I got into business with them, I found out that their investor communication sucked, that their capital raising sucked, that their ability to get on the phone with people, they would avoid calls. They were not good at leadership or addressing investor concerns. And like what that tells me, and the major lesson that the limited partner should listen and garner from that is, just because somebody's a great person, spiritual, whatever, doesn't mean that they're a great operator. So you want to be careful about not just liking the person or trusting a person, but trusting that person in the business. And you have to look beyond just the surface in order to uncover some of these things. So I would say like that's been one of the issues that I learned the most from. I'm actually grateful for it because I know what to look for now. It's like and like what's actually worthy of my attention. And it's not just someone being a good person, and you got to look beyond that.
Yeah, thanks for sharing that, because yeah, it's important. I mean, when you're looking at operators, and that's kind of going back to why I sit on the sidelines. I want to see communications. I want to get a peek behind the curtains of what somebody's doing before I'm putting my money with them, or bringing other investors capital
Yep.
to their deals. So that's a great point, Ruben, and thanks for bringing that up, because yeah, communication I think is everything. Whether it's something unexpected or not, right? Like getting out in front of it, communicating that. Like I think for me as an investor, that means more, than anything. Is just, I know and I understand that everything's not going to go as planned, but communicate that with me, right? All right, last and final question. If you could be remembered for one thing, what would that be?
As a person, I would want to be remembered as a person that was always trying to improve himself, and in the process try to improve the world by making himself more of a self-actualized person. So I believe that's a lot of people are like, oh, let me go help the world. And they try to do that before helping themselves.
Mm-hmm.
And that kind of almost sounds selfish, but I've heard it from so many really amazing people that I'm starting to understand like the greatest impact that I can make is to make myself great, because that person will be more capable of doing greater things than this version or a previous version of myself. So
Well,
contemplate that, guys. But I want to be remembered as somebody who's always trying to raise the bar for himself, someone who's trying to self-actualize, somebody who's always progressing, somebody who's reading, somebody who's excelling, and at least getting better a little bit at a time every day.
I love that, Ruben. And there's a saying that make sure your own house is in order first, right? So make sure you're armed with the facts about yourself. Then and only then is where you can go out and help others, right? Because you can't transmit something you don't have. So I was actually listening to a podcast, and a guy was just talking about the soul needs service. So I think we have to go out here and help others, and exactly what we're doing. We've been educating others on these types of investments, and really when you fall into this space, I mean, so many other avenues open up in the personal development space. That's been one of my favorite things about getting in real estate, is I've learned so much more about myself, right? Physically, mentally, emotionally, right? Financially, and I have a clear path now on my goals and what I want to achieve. So yeah, I agree. I definitely hold myself to a certain standard. And then when I do that, I can share with others as I get, as I raise that bar and I start gaining success there, then I can share with others on how I got there as well, right? And I think it's just that law of reciprocity. But my word this year is fulfillment, right?
Like it. Love it.
You
That's
know,
fantastic.
so anyways, man, great having you on here today, Ruben. I really enjoyed the conversation. And if you could tell listeners before I let you leave where they can go to connect with you.
Yeah. Right now I'm not raising for any deals. So it'd be a great time to talk to me, talk shop, pick my brain about what I'm kind of looking at, what kind of operators I'm looking at. Find me on LinkedIn. You can check out my podcast, Capital Raiser Show, at the website, capitalraisershow.com, or anywhere that you can listen to those episodes. It'll be available. Otherwise, LinkedIn, I believe, I'm on Instagram a little bit. Same thing with Facebook, but that's the main place. I like LinkedIn.
Awesome. Well, thanks, Ruben. Enjoyed it.
It was fun, man. Thank you. It's been an honor.
Thank you for listening to the Optimal Wealth Podcast. If you enjoyed this episode, please be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, be sure to optimize your results and take massive action on what you have learned here today. For more, visit optimalequitygroup.com.